Harry here with the rant on not just Friday, but Good Friday, April 18th. Start out really quickly. The markets have started to crash. I'm doing everything to monitor this and say, does this look like what I need to see is the typical first crash of a major bubble rather than just a deeper than average correction? And so far it is following, but if the markets are going to have the typical crash, which is 40 to 50%, particularly in the NASDAQ, the more risky market, and that's going to happen within 2 to 4 months, 2.6 on average, then this crash needs to keep going down soon, okay? So that's a big issue with me here, and I will continue to monitor that. But so far, we're on track enough. But again, we need to see more follow through on the downside, and investors should be planning for that and expecting that. That is the most likely scenario, that this bounce that we're in, which is natural, and I agree. Joh Del Vecchio, my partner, is saying something very similar lately. Hey, the overall direction still looks down in the markets, but stocks are very oversold recently and are due for a bounce, which we are in, and probably shouldn't last too long. So again, people that didn't get out or as defensive as they thought, and the market kind of went down ahead of them, here's another chance to get more defensive and either sell or be in treasury bonds or defensive positions or just cash. You know, there's nothing wrong with just being in cash until things become more clear one way or the other. Now, in politics, of course, you know, I don't take positions on politics for a reason. I don't want, my research is independent and is neutral. Okay? It's objective. That's the whole point. That's why I've been able to see things that people that favor one thing or another don't. So I don't take sides in politics, but you know, there's some policies here with Trump that are just clearly dangerous, okay? Number one, he's bullying the Federal Reserve Chairman, Powell. I'm sorry. The Federal Reserve was meant to be independent on purpose. I mean, the balance of powers is the key to the whole U.S. democracy and capitalistic system that's been the most successful in the world, especially on a large scale, okay? So you don't bully the Federal Reserve Chairman and say, I want you to follow the dictator's, you know, policies here, or you're out. But that is what's happening. Now, frankly, I mean, Powell's just got the higher ground here. So we'll see what happens here. But the markets don't like this either. And I've been saying to you and everybody I talk to, look, no question, we've had the longest, biggest, and 100% artificial bubble in history. That unique. And all this, this is a bubble waiting for a pin, okay? So it's also dangerous to be doing things like this at this time. And of course, that brings me to tariffs. Hey, tariffs may be warranted to some degree. Yes, maybe we've been too nice in the past. That's not our competitors' problems. You know, everybody cuts their best deals. You can't say, oh, China's been gouging us. And by the way, in Bain & Company, all we did was business strategy for growing companies and stuff, large companies. And it's a known strategy that when you're entering a new market, you may cut prices lower than normal to gain market share, because that increases your scale and lowers your cost and makes you more competitive and viable long term. So there's nothing surprising about China. Maybe they are underpricing a bit, but this is not outlawed in the free market capitalistic system of business. So why should China, an emerging country trying to grow up and become a developed country, and they're doing it very fast, but as you know, they have limitations in demographics that I think are going to disappoint more than anybody expects them to. But again, this is typical in business, so why wouldn't it be in global markets, okay? So tariffs might be warranted to some degree. Well, if we have tariffs, then they should be targeted to offset unfair tariffs against countries. And of course, China probably would have the most. But to totally go so hard on China is not fair, okay? So I think this is bad timing. Again, if you're going to do things like this there's no no question, and it's already happening, that we put on tariffs, other countries are going to respond and put on tariffs, and it restricts free trade, the secret to free market capitalism, around the world, and it's a lose-lose game. And again, this happened in 1929 to 30. Smoot-Hawley put on tariffs, and it was just it didn't cause the 29 to 32 crash. It was a trigger that just helped make it worse. So if I were Trump's advisor, I would say this is the wrong time to be pushing tariffs, and you should be very selective about how you do it. If you do, just to equalize. We're trying to make it fair. We're not trying to penalize countries from being more aggressive in the past. We did let them, okay? Any competitor that lets somebody gain market share on them without responding, they deserve to lose market share. So again, there's not much objectivity about this. And what I see, though, is bottom line, we have this 16-year run in stocks. I'm not counting COVID. That was a very short-term thing, and stock came right back to where they were as soon as that was over. That was a nothing burger. You count all the way back to early 2009, we're 16 years in a bubble. No bubble has lasted more than 5 to 6 years in history, and in fact, since COVID, when they turned on that 11 trillion out of the 27 trillion I've documented, that was huge, and the bubble has just gotten more extreme in the last 5 years, between early 2020 and now early 2025. So this bubble, the last 5 years, is a normal size bubble, but it came out of an already longer bubble starting in 2009. So this is bubble on bubble, greatest bubble in history, can only end one way, okay? A major crash. Now, second insight, of course, and this is something we just have to watch, and I'm going to be on this like a hawk. This will be the first bubble that governments did not only create artificially themselves, but they will also try to fight it. Governments have never been this active in the economy. This has only been since early 2009, okay? This has been a new chapter in history, and I think it's going to go down in history as the wrong thing to do, the biggest attack on free market capitalism in our history since it was created in the late 1700s, okay? This is how, I hate this sort of stuff. We're killing the golden goose here, okay? So, we've got, huge debt, 36 trillion, $2 trillion deficits currently in a boom. So what does that become in a recession, which I think is imminent? That could be 4 trillion a year. Get 2 to 3 years of this 4 trillion instead of 2 trillion. Next thing you know, we're pushing towards 50 trillion. 150, 160% debt to GDP ratio. Oh, and our GDP goes down substantially. It goes even higher. So again, this is the end. A lot of people, one of the biggest questions we're getting from our own subscribers and out there on Wall Street, Treasury bonds, they're secret. They're considered risk-free. They will never default no matter what because they can print money. Only governments, and particularly one the size and stature of the U.S. government, can print money to pay them if they have to. Well, we've already printed so much money, that's going to look more and more dangerous. And again, I just think we see a $4 trillion deficit and the economy goes down. All of a sudden, even Treasury bond yields being risk-free is going to be questioned. Do you know that the impact with our debt of 36 trillion going towards 50 at this pace, if the interest rate on the 30-year Treasury and 10-year Treasury just went up 1 percentage point, it's a ton of money over time with that size of debt. So this is a really important issue. Does the Treasury bond lose its risk-free strategy? Even with all the debt we've piled on since 2009, unprecedented, it has not yet, okay? It's still trading at the lowest yields for the duration of any major bond security out there, but that could change. And it's very dangerous for the U.S. government to even put us in a position that this could happen. So not a good time for tariffs, not a time to be bullying the Federal Reserve Chairman. That this is not a good strategy, policy, regardless. It goes after something very fundamental in our Constitution and everything else. So we're just going to see how this goes. But I'm telling you, there's only one way to lean here. And again, Joh Del Vecchio, my partner, has been saying the same thing recently. Yes, downside, it looks like overall, but the markets are due for a bounce. This may be the last decent bounce you see as an investor for a good while. So take advantage of it. Last time to sell things, you were, well, maybe, maybe not. And don't believe that this is a bottom. Very low chance this is a bottom in this correction in stocks. And I am looking, and again, I'll show this in the newsletter in the next issue in May. I'm going back to the analysis I did of every major bubble burst in modern history. And the first crash, again, 41%, 2.6 months, but anywhere from 2 months to 4 months, and anywhere from 28% to 50%, and we're going to be at the high end of that. This should be 50% for the NASDAQ. And if I look at the support on the NASDAQ and the S&P 500, the first crash would have the best support at 50% down approximately in the NASDAQ and 40% on the S&P 500. So that'd be the perfect first crash scenario. And shocker of shockers, that means the worst is going to come fastest if that's the case. By sometime in May, June at the latest, we could be down that much after this bounce, and this bounce could go a little higher. So again, all I can say is getting more unpredictable. Trump only makes it more unpredictable, and you know, he loves doing that. But truth is, this is a time to be as defensive as possible. And again, I'll keep you updated, and if we do not see this crash get much worse in the next month or two, it's going to say, you know, maybe this crash is not going to be as extreme because governments are on alarm to fight it. But I am going to use history as my guide, and so far we're still on track for that first crash to see a 40 to 50% downturn, S&P to NASDAQ at worst, by early summer, May, early June at the latest. So I'll keep you updated.